But beneath that calm surface, the tectonic plates are shifting. We're seeing persistent inflation creeping into our daily lives, particularly at the grocery store, even as official CPI figures try to suggest otherwise. Consumer spending is ticking up, a sign of ongoing economic momentum, yet the jobs report paints a picture of a labor market that's less robust than many would hope. This creates a delicate balancing act for policymakers and investors alike. Are we seeing growth, or just the lingering effects of stubborn price pressures? It's a market pushing forward, but with a wary eye on the economic rearview mirror. Get ready, because the narrative is complex, and the implications for your portfolio are profound. In the world of finance, certain voices resonate louder than others, shaping sentiment and even policy. Today, those voices are sending mixed signals, reflecting the very complexities we're discussing. Former President Trump, for example, is making his opinions known regarding interest rates, openly advocating for cuts and criticizing the Federal Reserve's handling of monetary policy. This isn't just political rhetoric, it puts pressure on the independent central bank and highlights a core tension between political desires and economic realities. Meanwhile, the titans of industry and innovation are also making waves. We hear that Elon Musk is re-engaging with US politics, a move that always carries potential implications for sectors like tech, energy, and even space. Jensen Huang, the visionary behind Nvidia, is reportedly heading to China amidst concerns about AI chip sales, a critical trip that could dictate the future trajectory of the AI boom and global tech supply chains. And speaking of AI, Michael Burry, the famed investor, is sounding a warning bell, suggesting that government intervention might be futile in preventing an AI bubble from bursting. That's a stark contrast to the prevailing optimism and a reminder that even in the most exciting technological shifts, skepticism has a place. These are the narratives, the whispers, and the shouted opinions that define the currents of capital, and understanding them is key to navigating the choppy waters ahead. Let's pivot to the often understated but absolutely critical bond market, because this is where the true battle over interest rates is being waged. The 10-year Treasury yield, a benchmark for everything from mortgages to corporate debt, showed a slight dip today, a subtle signal but an important one. Why is this happening, especially when you have figures like former President Trump openly calling for lower rates? The bond market, my friends, is a beast of its own, driven by supply, demand, and deeply ingrained expectations about inflation and economic growth. The market isn't simply cooperating with political wishes. It's reacting to underlying economic data. If inflation remains sticky, as suggested by rising grocery prices, then bond investors demand higher compensation for lending their money. If the labor market is lackluster, as Reuters reported, that might temper expectations for aggressive rate hikes, but it doesn't guarantee cuts either. The current tug of war illustrates a fundamental truth. The bond market is a forward-looking mechanism. It's anticipating future Fed moves, future inflation prints, and future growth trajectories. While politicians can voice their desires, the market will ultimately price in what it believes to be reality, and right now, that reality is a complex mix of persistent inflation signals and a less than stellar jobs picture. The bond vigilantes are awake, and they're holding their ground. The bond market's stance brings us directly to the central banks, the ultimate arbiters of monetary policy. Both the Federal Reserve and the European Central Bank are under the microscope, their every statement dissected for clues about the future of interest rates. We heard from Reuters that the ECB is in no hurry to change rates, a comfortable position given current market bets. This suggests a cautious, wait-and-see approach across the Atlantic, acknowledging the persistent inflationary pressures we're seeing, particularly with UK inflation overshooting forecasts. On this side of the pond, Fed Chair Jerome Powell continues to face intense scrutiny, with Trump directly criticizing the Fed's performance. The pressure is immense, but the Fed's mandate remains clear: price stability and maximum employment. The latest economic data, rising consumer spending alongside a weak labor market, presents a quandary. If spending remains robust, perhaps inflation will linger. If the job market truly falters, the Fed might face increasing calls for easing. But as Ray Dalio has warned about a riskier dollar, central banks are walking a tightrope. Their decisions aren't just about domestic policy. They have global implications, influencing everything from commodity prices to currency valuations. They are operating in an environment where past playbooks might not apply, requiring a blend of data-driven decisions and careful communication to manage market expectations. Now, let's talk about the raw materials that fuel our world, because the commodity markets are truly dynamic right now, reflecting both economic fundamentals and simmering geopolitical tensions. Gold, my friends, is absolutely shining. It just pierced the $4,900 mark, an astonishing new record, and silver and platinum are riding that same wave, extending their own record-setting rallies. This isn't just about inflation hedging. It's a profound statement about global uncertainty. As Ray Dalio aptly notes, in an era of a riskier dollar, investors are turning to the timeless safe haven of gold. It speaks to deeper anxieties about geopolitical stability and the long-term purchasing power of fiat currencies. Meanwhile, the energy markets are a tale of two narratives. Crude oil, both WTI and Brent, saw modest gains, buoyed by ongoing supply concerns and geopolitical machinations. The news that U.S. control of Venezuelan oil production risks a debt restructuring showdown with China is a potent reminder of how geopolitics directly impacts global supply and pricing. OPEC's influence, combined with these complex international relations, keeps a floor under oil prices. Natural gas, however, is a different story of dramatic swings. We're seeing a massive surge in prices, directly attributable to the Arctic blast threatening nearly half the country. This isn't just seasonal demand. It's a stark reminder of the vulnerability of energy infrastructure to extreme weather events, and the immediate, powerful impact that has on household budgets and industrial costs. The volatility here is extreme, driven by the very elements around us. Zooming into the specific sectors, we see a fascinating interplay of growth narratives, cautionary tales, and underlying economic forces. Tech, the bellwether of innovation, had a mixed but generally positive day. Mega caps like Microsoft, Amazon, and Google all moved higher, indicating a continued appetite for dominant platforms and cloud services. Apple also nudged upwards, demonstrating its enduring brand strength. The real story, however, often lies in the outliers and the sector-specific news. Nvidia, the undisputed king of AI chips, saw its shares move positively today, but the critical headline about Jensen Huang's visit to China due to stalling AI chip sales is a red flag. It highlights the geopolitical risks and the intense competition in the AI space, suggesting that even the strongest players face headwinds in a complex global market. Tesla, often a volatile stock, rallied significantly, perhaps on renewed optimism about its production targets or strategic initiatives. And then there's Meta, which surged, a testament to its ongoing ability to monetize its vast social platforms and push forward with its metaverse vision, despite past skepticism. Financials, represented by the XLF, also saw a solid day. This sector thrives on economic activity and interest rate expectations, so a resilient market and stable, albeit high, rate environment can be beneficial. Energy stocks, reflecting the modest gains in crude oil, also edged higher, benefiting from the geopolitical undercurrents in the oil market. What we're seeing is a market that's rewarding growth and resilience, but with a keen awareness of specific company catalysts and macro geopolitical risks. Now, let's venture into the fascinating, often volatile, world of digital assets, where the narrative today is particularly compelling, especially concerning corporate adoption and strategic plays. Bitcoin, the undisputed king of crypto, showed remarkable stability, holding its ground just shy of that truly significant $90,000 psychological mark. While it hasn't broken 100K yet, its sustained strength at these elevated levels is a testament to growing institutional interest and perceived legitimacy. Ethereum, the backbone of decentralized finance, also remained relatively flat, echoing Bitcoin's steady performance. But the real drama in this space centers around MicroStrategy. We saw an analyst downgrade the stock's price target, a move that often sends shivers down investors' spines. However, to truly understand MicroStrategy, you have to understand Michael Saylor's Bitcoin playbook. He's not just buying Bitcoin, he's fundamentally transforming his company into a Bitcoin development corporation, using its balance sheet as a strategic vehicle for accumulating the digital asset. This isn't a traditional tech company valuation anymore. It's a leveraged bet on the future of Bitcoin itself. Michael Saylor believes Bitcoin will win, and his entire corporate strategy is built around that conviction. So, while an analyst might see a reduced price target based on traditional metrics, the true believers in MicroStrategy are watching Bitcoin's trajectory. This is a story about conviction, corporate strategy, and the bold, often contrarian, vision of a single leader. It's a high-stakes game, and MicroStrategy is playing it to the hilt. Looking forward, the next trading day promises to be another test of market resolve, with several key themes likely to dominate the headlines and investor sentiment. We'll be keeping a close eye on the unfolding inflation narrative. With grocery prices still rising and UK inflation overshooting, any further data points or central bank commentary on price stability will be paramount. Expect volatility around any fresh economic reports, as the market desperately seeks clarity on the Fed's future path. Geopolitical developments will also demand attention. The situation around Venezuelan oil and its implications for global crude supply remains fluid. Any escalation or resolution could quickly shift energy prices. Furthermore, President Trump's continued engagement in international affairs, exemplified by the historic peace ceremony regarding Gazans, adds another layer of political complexity that could influence investor confidence. Finally, pay attention to the ongoing saga of AI chip demand, particularly with Jensen Huang's visit to China. Updates from Nvidia or any of its competitors regarding sales or market access could send ripple effects through the entire tech sector. It's a dynamic environment, full of potential catalysts that demand constant vigilance. But on the other side, you have the relentless march of innovation, exemplified by the resilient tech giants, the strategic brilliance of companies like MicroStrategy making bold, conviction-based bets on Bitcoin, and the very real safe haven demand for gold, which just pierced an astonishing new record. This isn't a market of clear skies or stormy seas, it's a market of swirling currents. The message is clear: focus on the why. Understand the underlying narratives, the geopolitical chess game, and the strategic plays by corporate titans. Because in this complex tapestry of global finance, knowing the story behind the numbers is your ultimate edge. Stay sharp, stay informed, and I'll see you next time.